There's a famous saying, if you think compliance is expensive, try non-compliance. Especially after the COVID-19 pandemic, threats have been getting more complex and the world is drowning in data. The financial industry seems to be heavily regulated, and trying to comply with these regulations can be cumbersome and expensive. When the COVID-19 pandemic was going on, there was also a huge surge in online transactions, which could breed more non-compliance and crime. How can this be dealt with? How can there be prophylactic measures and compliance to deal with data-intensive operations? How can risk and fraud be recognized? This is not just a question for regulators, it's also important for companies, both big and small. How could startups, for example, with limited resources, solve resource-consuming problems? That's where RegTech comes in, regulatory technology. This is the innovative use of tech, AI, machine learning, and data analytics to streamline and strengthen processes of regulatory compliance. These RegTech solutions are usually developed and offered by private companies in the tech and financial services sector by creating tech tools and platforms. These companies often collab with governmental bodies, regulatory agencies, and industry associations to make sure their solutions align with regulatory requirements and standards. There are regulations, guidelines, and standards that need to be followed. And if these are not adhered to, there could be legal repercussions, penalties, fines, business could be lost, customers could leave, and more. And if you're an international company, there could be local laws which could vary from region to region and country to country, which adds to another layer of complexity. There seemed to be some inadequate regulation and supervision during the 2008 global financial crisis, leading to some changes and an evolving regulatory regime. After that, people and entities had to figure out what business models and tech could be used to avoid similar disaster. So what's the keyword after that? Disruption. Disruptive use of tech in the financial sector meant that there were more regulatory laws. This led to the emergence of RegTech. RegTech is any tech that ensures companies comply with regulatory requirements, achieve compliance requirements, and that business systems and data follow the letter of the law. RegTech spending may reach more than $127 billion by 2024, compared to $25 billion in 2018. Structured data is fed, there are training cycles, and the tech learns to determine what could cause a red flag. Let's take, for example, anti-money laundering, also called AML, which is all about the stopping of concealing illegally obtained money in businesses. So, financial institutions have to make sure there's due diligence to make sure financial crimes like money laundering doesn't happen. To handle this, the process could be time consuming and there could be errors. With RegTech, financial institutions could automate due diligence and make it more accurate and faster. The possibility of inaccurate data is reduced and the odds of mistakes happening could even be diminished. So, transactions could be tracked, compliance could be monitored, and violations could be reported. There's regulatory intelligence where there are solutions and platforms that keep companies updated on whether regulations have changed or evolved. Then there's transaction monitoring and reporting where you have something like anti-money laundering to identify if there are any troublesome or non-compliant transactions at any scale. This is where consumer transactions like deposits, transfers, and withdrawals are tracked and monitored to see if there are any suspicious behavior or any financial crime. Regulatory bodies like SEBI and RBI may depend on transaction monitoring for AML policies. There's also automated account verification, like KYC, which is Know Your Customer, where there's verification and identification of a person's identity when opening an account. There's also a digital or regulatory sandbox, where there's a framework allowing for fintechs, startups, and other entities to test products and solutions in a controlled environment with the approval of regulatory authorities. Just like a kid making sandcastles, the proof of concept in the form of a sandbox would demonstrate practical applications of new tech and new business models to help entities put their solutions out. Why is this necessary? Because global financial institutions have been hit with about $10.5 billion in global fines and penalties related to AML, KYC, data privacy, and more in recent times. RegTech has been called the new fintech, with India's fintech valued at around $585 billion as of 2022, making it one of the world's biggest fintech markets with high adoption rate compared to the rest of the world. RegTech seems to have a strong mass ahead. It seems to be a win-win as financial institutions would safeguard their clients' needs, the clients would get better and speedier service, and regulators may see a more regulated market. There's a collective headache that could get reduced and automated. And of course, there are always going to be bad actors, people who try to operate outside of the law and find loopholes. Nonetheless, there could be some flaws with RegTech because compliance tools may be leaving the interpretation of legal issues to computer programmers. So, There has to be adequate training data from legal experts. But these are creases to iron. It doesn't mean that RegTech doesn't have the potential to make compliance better. That's why human intervention is also needed to keep a watchful eye. But teaming up with RegTech, that's going to make things smoother. RegTech, it could be the hero that businesses deserve and also need, a silent guardian, a watchful protector, a dark